When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Okay, we're having some weird issues with Twitter on this end too. Thank you, guys. All right, let's start over. It's MacroEdge Radio number 47. We apologize for the technical delays, but X is acting squirrely. It has been acting squirrely all week. We were trying to get the show started, and oh, wow, what a mess. And I've noticed that we've had quite a few issues with this, so hopefully we'll stay up for the entire hour. We'll get all our guests in. We're doing another macro show where we're going to talk about the markets, macroeconomics, real estate, housing, credit, you name it. We're going to bring some of our team back on to discuss this. I will be selecting people to come on in and speak, bring your mind, bring your local anecdotes, etc. Here's the bigger issue. The markets today had a decent rally, however, low volume, terrible breath, nothing really special going on. I was up to the point where I said transports were your non-confirmation down 275 to about 13,486. That was a couple of minutes for the close. Same for gold down 26 to 33.20 after kissing 3,500. Silver down 51 cents to $33. WTI up 41 cents to 63.20. Brent up 45 cents to $67. 10-year down 4 ticks to finish the week at 426.30. 2-year down 0.27, finishing at a 3.764. I want to follow up on bonds. If you want to come to my blog, and I'm sure it'll be available at MacroEdge, we're going to talk about all this funky stuff that I've been posting on X about Asia and the sell-offs in T-bills, because there has been a non-stop sell-off of our T-bills. And there's a reason for that. This trade war is deteriorating not just the economy, but the faith in our credit markets. We're going to talk about that with some of our macro people today, but I had to catch Craig Fuller from Freight Waves. Somebody I have conversations with on and offline privately. And he was on CNBC today. He pointed out a very important fact that 90 voyages have been canceled on the Trans-Pacific route. This means, and we're also seeing more empty containers being transported between points because they're getting bottled up in China and bottled up in the United States. We unload a container. If we have nothing to export, that's got to get relocated to a different location where they can fill it with something. And let's face it, folks, economically speaking, it's no different than a semi. When we send them empty out of Florida to Atlanta, Savannah, or wherever, it's the same principle, except it's on a boat, and it's a lot bigger, and there's a lot more of them. Another quick thing here. So far, and this is what you're going to need to watch for, and I'll be paying attention to this in the next month or two, the Port of Long Beach. Right now, year to date, for the first quarter, the TEUs, which is how the number of containers, 20-foot equivalent unit, measured, come in, and it was up 27.1% year over year. At this pace, we shall have a huge year if it were to maintain. However, we're already seeing cancellations, delays, and reschedules. And I got a funny feeling that what we're going to see by the end of May is going to be quite damning and will be a leading indicator, as Craig said, for the back-to-school season, because that relates to retail, and that's what the masses want to see. More importantly, the direct impact will be felt in the next 4 to 6 weeks, hard and heavy on, unfortunately, and I do say this, unfortunately, small industrial enterprises, small factories, small manufacturers, and intermediate ones, less than 100 employees. They get a pallet or 2 pallets off of a container. The product is put into production, used to make a subassembly or assembly that's used on something larger, be it a car, boat, plane, whatever. If they can't afford and pass those costs on to the larger manufacturer, they're done. They're going to let people off. They're going to go out of business. That's just reality. And that's not what's being measured in the economy. That's why earlier this week I pointed out, if we had 10% of companies, 10% of the people laid off at companies with less than 249 employees, you're talking 9 million people hitting the unemployment line before the end of this year. So think about that, folks. The consequences of 9 million people being added to the unemployment rolls, hell, half of that, 4.5 million, are so damning. It changes our political structure and our economy overnight. So buckle up. Things are about to get wild, and today's activity with the trade war was not reassuring with he said, she said, going back and forth, the trending catchphrase of the day. First, I want to bring on Melody Wright. She's been kind enough to join us again. Melody, how you been doing?
I'm doing well, John. How are you?
Pretty good, pretty good. So tell me, what do you make of what you've seen in housing this week? Because the builders didn't exactly report the best of the best.
I got to tell you, I was absolutely fascinated with the March results, John, and encouraged in a couple of ways that, perhaps is not going to be encouraging to other people. But what we saw in the median home prices was just absolutely fascinating, with kind of the new homes coming in slightly less expensive than existing homes, and that's only happened a couple of times in that series, one of which was in June of 2006, and it happened a few times over last summer, but they got revised away. So I've posted a chart this week on Twitter where you can see the historic relationship between new home prices and existing median home prices, and we are reaching trouble. And if these results stand, then what I believe we're about to see in the next couple of months will be a year-over-year negative print in existing home prices. Just looking at the numbers and where they came in, and because what you're seeing right now, the builders are kind of stealing market share for the lower price tiers under that 500K range, and their results were very strong from in perspective of what they've been doing in the past several years. And those price cuts were significant, and that lower median price is telling you that they are going pace versus price, and it's going to put some significant pressure on the existing home market. No one pricing a home under 500K is, they are going to be in direct competition with the builders. But yet again, what we saw on the existing home side is really one of the worst marches that we've seen in the last 26 years, only behind 8, 9, and 2011.
Well, this brings up the next problem. We see a demographic shift occurring. We're starting to see the boomers begin their die-off period, which we all knew was coming. And when I say that, folks, I don't mean it derogatorily. I am a boomer by technical definition of somebody, although I don't feel like one, except on Monday mornings. Yeah, what can I say? The people who are passing on, and I asked you about this earlier, I'd like for you to fill this part of the puzzle in, because everyone thinks that the younger people are going to move into their parents' home. But the reality in states like Florida and Arizona and multiple other states, a young person who is struggling to pay their bills now can't afford to assume the cost responsibilities, including property tax, insurance, et cetera, if they inherit a home. And that's just adding more market pressure, slowly building over the weeks and months ahead. Not to mention the problems we're having down here and elsewhere with the elderly on fixed incomes unable to afford the homes they're in now, and may become forced sellers in large, just tremendous numbers down here and elsewhere. I don't think people understand that.
They don't understand it. And it's so important, John. So Harvard came out, they do a kind of a demographic household formation study every January. And the last one that they came out with, talked about the fact that we're going to lose 15.6 million boomers between 2025 and 2035. Between 2035 and 2050, that number goes to 25 million additional more boomers. And we know they own the majority of the homes. But let me start with one of your second point first, which is the ones that already own and are on a fixed income. So in Pembroke Pines, this is when I was living down in Miami for a couple of months in 2023, there was a big hullabaloo because everyone in the Pembroke Pines got their notice that their HOA was going up because of insurance increases. And this is very much a middle class condo subdivision. And so I started tracking it. And John, from that time period where basically the residents stormed the office, the police had to be called, basically saying they can't afford it. They're on a fixed income. You have seen inventory increase exponentially in Pembroke Pines, and that's just one little example. But it's actually happening all over the country. I've had several people contacting me trying to get help and assistance with properties they are going to inherit. Either just like you say, they can't afford it, so they need to sell it, and there are multiple heirs involved, and so they're trying to, get the best price or whatever. Or they want to keep that property because it's in a, destination location like the Jersey Shore, and sell their current property. But what you're seeing that's not one person. It's two siblings retiring to the same house, and so we're seeing consolidation of households. And I see Kenny Cap PhD is on here. He noted that last year, for the first time in some time, we have seen that average or household size actually increase. It was going in the other direction, and he's made a really funny joke about, do we want the household size to go down to one? Because that's what the housing bulls are basically arguing. We have more housing per capita than we've ever had. So John, no one quite understands what's coming with that tsunami of these boomer properties that, like you say, many of the heirs simply will not be able to afford them.
With that in mind, the sales distortions we're seeing because of the discounts offered by the builders and stuff, as credit becomes harder and harder to obtain, that's got to come to an end. They cannot just keep extending and pretending on credit to the subprime community, can they?
No, and I think, with the administration shutting down and putting some guardrails in the FHA program and shutting down how many times you can go to the till in a certain amount of time, they are definitely signaling that they're not bailing out housing. And so, we are about to enter a season that we have not seen since the GFC, meaning that, foreclosures are going to get sexy again. Default is going to matter again. And you are seeing a lot of the things that have been propping up housing kind of exit stage left. And the biggest is the narrative, and that, the government would always be there to support housing. And you're definitely getting signals from the administration that they're not going to step in and save it. Now, when things get bad enough, they will do something, or the state AGs will, but it's going to take some significant pain to come before you're going to see them intervene. And this is just a housing market that most people do not know and understand. And it's really only those of us that were there during the last crisis that really can see these signs and understand what's ahead.
Well, let's bring this back into your bailiwick, and I'm going to put this right over the plate for you. That under consideration, and the trade war bouncing all over the place right now, which I think has a risk of deteriorating into a financial war. Why would any foreign financial entity or responsible bank buy our mortgage-backed securities?
Only with a gun to their head, John. And I think that I think what will probably happen, and what I've been seeing from the administration is, essentially, it looks as if they're going to try and give relief on the supplemental leverage ratio so that the banks come back to the table. And then, Stephanie Pomboy did an excellent show with Adam Taggart on Thoughtful Money on this. But basically kind of forcing the banks to buy our treasuries, buy our mortgage-backed securities. But she argues that that's going to cause other problems, because then you won't have capital flowing to Main Street, of course, which is what, the administration is saying they want to happen. But I do believe that you're going to get that relief on the SLR. A lot of these non-banks probably won't exist anymore in the next few years. And you're going to see a lot of mortgage come back to the banks, and the end of this really ridiculous experiment with the governments plus the non-banks.
So you're thinking the same thing I'm thinking, that private equity is about to bail out of the housing market also because they can see the handwriting on the wall, and they're going to pull the ripcord and bail also and leave the banks and ultimately the taxpayers to foot the bill for this again.
Yeah, I don't think they have a choice. When we say bailing out, I mean, yeah. So I think, yeah, they're putting on the parachute and jumping. I mean, this is crashing and burning so hard and so fast, and a lot of the, the privates, they can get away with a lot of stuff until one of their liquidity facilities dries up, and I find it very telling that Apollo has been borrowing at the FHLB window. And that's the Federal Home Loan Bank, which, one of, we really shouldn't be seeing Apollo there. So I agree with you. I think that, they played a little game over the last couple of years where they would sell to one another in real estate so that they wouldn't have to take, significant losses, especially those ones that were private and weren't subject to kind of mark to market. But those games are over, and so you are about to, in my opinion, especially in big markets like San Antonio, Atlanta, where you have a lot of institutional representation, they are about to start distress selling. And the builders are creating a lot of that pressure as well on them.
Well, I don't want to eat too much of your time because I know you've got some other stuff to do today, but I got to ask you this question. Are we going to see realistic mark to market, not just for the credit side of it, but for the housing price side of it? Because it does look like the conforming loan limits are up for debate also from this administration, which would have massive effects on the industry.
Yeah, John, I was talking to someone earlier today. Like, I feel more confident than I have in a while that we really are going to see these median home price declines, and we're going to see them sooner than I think most people are thinking. And it's just by nature of looking at that, honestly, the relationship between the existing and new market. Existing has nowhere to go. And, we've really run out of people from the credit perspective that can qualify for a lot of these homes now. And then you tack on, and I see Amanda is on here, and she and I did a show a couple of weeks ago where we talked about these impacts of the student loan, now that student loans are due again, and for those previously defaulted borrowers, where you could see as much as a 180 drop in a credit score. You think about somebody that was sitting at a 750 or 800, what that means to them. And so, I think that that's partially why the Fed came out with such a high mortgage refinance rejection rate in its last survey. But we have not even begun to see the impacts from these, 5 million borrowers that are about to be forcibly collected on through wage garnishment and things like that, as well as just a credit score impact. So, yeah, I mean, it's really kind of funny, John. I've been talking for 2 years about this moment, and I think that I myself almost believed it wouldn't happen, but we are here now, and all of this stuff is happening all at the same time. And so I absolutely think we are about to see, and it could be sooner than most expect, a year-over-year drop in NAR series for median home prices. And the builders are already down 7.5% year-over-year.
I think you nailed it. And I think the biggest issue I've seen some of the reports of credit scores theoretically dropping from 720 and 740 into the high 500s. The other shoe for that people don't understand, and we'll have to get Neely on again at some point when she's free to talk, is that credit cards, and people don't know this, are just another loan. They're callable. And that means your credit line could be $5,000 today and $500 tomorrow when you get that kind of cut in your FICO score. That's pretty terrifying when you add that on top of the problems with a house. If you think you have equity in the house and took out a $15,000 home equity loan and your HELOC is eliminated because of your FICO score,
yep.
I don't think the banks are ready for that. Do you?
No, and John, I mean, so it's us oldies that, because we've been down this road before. And I mean, I cannot tell you, I remember the day that we started freezing HELOCs, right? And how we aggressively went out just freezing those left, right, and center. And so that will happen again. And my thought went just like yours, first to the credit cards, because I saw some other survey today that, something like 48% of Americans over 50 have over $5,000 in a credit card balance. And so they are using their credit cards to live. And therefore, as soon as you get told, hey, you thought you had $1,500 of credit every month that you could use to live for food, whatever. No, you now have 750. That really changes the game.
Well, Melody, please plug your Substack. Let us know about your future media appearances, because it seems like every podcast or TV show I switch to, I get to hear your voice, which is great because I always learn something. And right now, living in Florida, I'm looking into investing in a bomb shelter. That's a Florida person, guys. Go ahead, Melody.
Sure. So you guys can find me here on X at M3_Melody, M3 Melody Substack, and M3 Melody YouTube. And just a big fan of this group. And, I learn so much from them every single day. We are always actively talking to one another. And there's just a lot of great folks here. And so appreciative of this forum. And thanks for letting me join.
Oh, thank you for your contributions, and it's a pleasure to hear you. I wish that I could have had you on my radio show in 2007 and 2008, because I'm sure the war stories then were just pretty similar, if not crazier, at that time.
Oh yeah.
Thanks, Melody. You have a great weekend, folks. Don't forget MacroEdge.net Ozone. MacroEdge.net Ozone 2-week free trial. Go to MacroEdge.net and subscribe. And also check out our real estate. We're our real estate experts, Kenny, Mr. Awesome, Ulysses Awesome, Melody, all right, great pieces that you can pay attention to. Get a hold of that. Give it a drive. You might even read something from yours truly. And yes, sometimes I can be rather snarky, but that comes with the territory. Next up, I'm going to bring Six up here because, did anything happen in the markets this week, Six?
Yeah, it's been a really interesting week. So the last time that I was on here, it was that Friday before we put the low in on Sunday night into Monday morning futures, and we saw the top of the bond rally, and then it reversed pretty drastically, and it's been super interesting what's been going on since then. So you had other safe haven currencies, and the United States dollar is typically a safe haven currency, but you had the yen drastically bidding against the dollar. You had the Swiss franc, which francs are about to go, the Swiss are about to cut interest rates to negative. That's what they're projecting. So there's no interest rate differential benefit there whatsoever. So you had, people selling dollars where they got, if you're parked in T-bills, like a little over 4, and then buying francs with no yield. So that just speaks to the concern in the market about U.S. assets overall. And then, bonds have somewhat found a bid. The dollar has begun to stabilize against the other safe haven currencies. And if the troughs are in the USD against those pairs, I think that it's probably pretty likely that the exodus from U.S. assets is over, and we start to see more marginal inflows. Now, equities have reversed. Everybody saw the Zweig breadth thrust thing today and yesterday. Done on relatively low volume. The volume honestly was more indicative of a bear market rally than it was, the breadth increase was not also accompanied by a surge in volume. So that's kind of a cautionary for me, but obviously the technicals are super bullish, and anyone who's ever traded with leverage knows that it's not a loss until you sell is totally wrong, and wherever the price is what it's worth. And you can't fight the price. So right now we're pretty bullish technically. Trump came in today and, was pretty, only the Fed is dovish or hawkish, but for lack of a better word, Trump was pretty hawkish today in his rhetoric around China, other countries. He's been pivoting back and forth all week. It's been kind of wild. But what is interesting is that the Fed speakers have more shifted into away from, we're not going to cut, we're going to wait and see, to, now June's back on the table, probably to go 25. So with the Fed back in, with a tilt towards easing again, that's coming into focus in the near term, that's another, buoy for risk assets. What's really interesting to me is that, none of the economic effects really have been felt yet from these tariffs, especially the ones on China, because they, just went into effect earlier this month. But if you look at freight bound for LA, it's just collapsing. It's down almost 50% in the forward projections over the next few weeks. So you're seeing a real drop in imports, a huge one. At the same time, we're seeing manufacturing surveys cratering. So it's not like the pivot from foreign goods to domestic goods is also accompanied by a surge in manufacturing. It's quite the opposite. So this relief rally on low volume in risk assets is to be taken with a grain of salt, I think, because we haven't felt the effects of the tariffs yet at all. And regardless of the overall level that we end up with on the effective tariff rate, it's still going to be high. On China, it's almost certain to be high. And, we're moving higher because of a perceived marginal reduction in tariff rates. But, even if they were to greatly reduce tariff rates, I still think we're trading too rich on the S&P, considering all the uncertainty, considering all the changes. Considering the, how do we think about what premium U.S. assets should get over the rest of the world in the U.S. exceptionalism scenario? Our stocks have traded at very high multiples relative to the rest of the world because of our perceived stability, our reserve currency status, and other factors. But if we are to remove that stability, and the United States is actively making a push towards deglobalization, which, regardless of where the tariff rates settle, I don't expect that part to change as of yet. I mean, I've been changing my mind very, very consistently as the rhetoric from Washington changes. You have to stay super flexible here, I think. But I don't see that the shakeup that they're doing changing anytime soon. And
I'm going to add to your concerns because I'm what a kind of a geek I am about data. And Captain Sal Mercogliano, highlighted and did an analysis of the Port of Tacoma, Port of Seattle, and it's down. Vessel calls and berth time are cut in half. I'm reading from his X posting, guys. Terminal may close for another day. They've been open 6 days a week. They may close Saturdays and Sundays. Export rows are nearly empty. And one reporter, this is one of the porters or dock workers. One worker reported this is the least amount of hours he or she has worked in several years. So, folks, we're losing our West Coast ports. That means that more cargo is being dedicated to Latin America and to inter-Asian trade. I don't think China has any reason to come back to us. And they've actively been out in Africa, Asia. Z took a trip this week. I don't think Trump understands this isn't 2018. And that's what scares me about the premium you're talking about. We're valuing this like you can turn the switch back on. It's going to be normal tomorrow. And my calculations are for every 2 weeks that this drags out with reduced port traffic and reduced settlement on a livable tariff, which 60%, 50%, whatever is not livable, by the way. We're still locked down and shut down with an embargo. It's going to take 4 weeks to recover. So right now we're already into July if we were to have this turn back to the way it was now. I don't see us pulling this off. And that's why I'm wondering, is there too much faith in the risk premium for the U.S., plus what's been going on in T-bills, which I'll get with you in a minute?
I think so. I mean, going into this, we were trading at 23x forward PE. I can't remember the CAPE valuation, but it was the second highest on record behind the dot-com bubble. So valuations were extremely stretched going into this. So even say everything goes away and say there were no economic impacts at all from these tariffs, now we've lessened our appeal to international investors, and you have to knock some off the forward multiples just for that alone, and then you add back the uncertainty, you add back the direct economic effects of tariffs, and then you also add in the investment. Nobody's making big investments right now when they don't know what the policy is going to be next week. Like, it's so difficult, and regardless of, like I said, like where the effect ends up, tariffs are going, these larger tariffs that are going to stay in effect in many cases, or at least be somewhat in effect, they're a huge headwind to more economic growth. So you have to, in addition to taking out some of the premium from U.S. exceptionalism, you also have to then think about what are these assets really worth when the best case scenario is below trend growth. I think that's as good as it can possibly get, is below trend growth.
Well,
trend growth, I definitely don't think we'll have.
Well, everybody seems to jump on the stagflationary train several months too late, in my opinion. And I think that this wild card that we're being presented with is not being highlighted because we're seeing the impacts hitting the consumer directly. I'm going to give you two postings that were up on X today real quick. First one, and it goes back to what Melody and I were talking about, 48% of Americans over 50 have a balance of $5,000 or more in credit card debt, and 28% carry a balance of $10,000 or more. Well, who were, pardon this, millennials, get all upset at us old boomers for saying this, who were the people who said, oh, don't worry, Joe Biden's going to get rid of our student loan debt? And now their FICOs are being obliterated. This is not investment advice, folks. This is a legitimate question. But does this not offer the potential for shorting retailers, especially the ones who are stuck in the older models and not the ones that are participating in the internet direct-to-customer model?
Yeah, I would say so. Consumer discretionary very selectively, I think, is a good short. Very selectively. Like, you want things that nobody needs. Like, $150 Lululemon leggings. Nobody needs that. Very selectively. In terms of what are interesting longs, I think, shipbuilders. China makes, I read that in 2022, the U.S. made like 5 ships, and China's just pumping them out, and the administration has this big drive to increase shipbuilding, and Trump just talked about he wants to increase the Pentagon budget by $150 billion. In a more polarized world like that, I think, shipbuilding is going to be, domestic shipbuilding is going to get a real boost. And then aside from that, like, I have no interest in just being long beta. I want to be in things that the administration is pivoting into from a policy standpoint and where the capital is going to flow, ideally to sectors that are already cheap relative to the S&P multiple. But I feel like you got to be really careful, and there's really not a whole bunch I'm excited about buying. Credit spreads started to blow out. Not really, but I mean, like not as tight as it gets to, quickly widen to 450 on high yield spreads. and we've since retraced about half of the more aggressive move down to 350 or so. High yield credit, I wouldn't get involved in that at all. Private equity, I think, is going to take a pretty big hit. You're starting to see China said that they will not allow Chinese to participate in new United States private equity deals. So there's a marginal buyer removed completely from the equation. Then you have endowment funds like Yale is selling $6 billion of their PE. Harvard is selling $1 billion to start of their PE. And these, they mark these all to model, and you don't really find out what they're worth until a big seller steps into the market and tries to liquidate. So we're going to see how that turns out. But I mean, I've seen firsthand, private equity managers marking up the first quarter. The S&P was down like 10%, and then private equity managers are like marking their book up to model. So I mean, those valuations are just built on kind of fantasy, and they're not very much tied to the real economic story. So it'll be interesting to see where those shake out whenever there's larger liquidations in the market and they have to find a real buyer.
One final question, because I'm going to throw this at you, because this does directly relate to the pool of liquidity available for investing. Hardship 401k withdrawals running 15 to 20% above normal. Is this finally a sign that parts of the retail idiocracy, the hoodies, the crazy people, the people who bought a stock called RTC, a Chinese software company, and folks, there's a reason not to invest in China right now if you haven't been paying attention. That's a penny stock that traded over 250 million shares today. Folks, this is beginning to concern me, because once retail finally figures it out that they've been buying from the institutions, the trap door opens pretty quick when there's a panic, doesn't it?
Yeah. And then in terms of the 401k distributions, I mean, I guess it would depend on, I'm not familiar with the figure you're talking about, but I guess it would depend on, is that 10 to 15% above normal? Is that adjusted for market price and inflation? I don't know.
Yeah, they didn't, of course, Bloomberg didn't sit there and specify that. So we're all asking, is that based on, like you said, inflation adjusted? But it does seem that people are taking loans out against their 401ks just to take care of bills, medical issues, etc. It starts to add up.
Yeah, and like you said, that student loan hit now that that's coming into like I have a client who has $160,000 in student loan debt and is paying $145 a month on it, and is telling me that they're trying to spend less time working. And I'm like, you are gonna get shafted when you actually have to start paying on this, which is right. So look.
I hope he learns how to deal with collection agencies, because he'll have a great time, especially the government collection agencies. Trust us on that one.
Yeah.
Six, thank you for everything. Tell everybody a little bit more about what you're doing with MacroEdge and where they can find you. Okay, well, we're back. That was, right now, I hate to say this, folks, and we only got 10 people back in the room. We lost 6 who was on the road, so I don't expect them to be rejoining us. You can read more at macroedge.net/ozone, macroedge.net/ozone. This site, and I'm saying this as a hint to Mr. Doge to get his shit together, and I don't apologize for using that word. He really needs to fix it. If you're going to be serious about having a social media site, fix the stability of X. It has become absurd, absolutely absurd. And I am sick and tired of the website crashing. He wonders why I don't publish my articles here. It's because I have no damned idea if this thing is going to show up, crash, burn, or whatever. And a lot of people are abandoning this, and we may end up on Gasp, YouTube. I think we might have to do that, folks, so stand by. That time could be coming. I'm not trying to sit there and denigrate X. It's a much easier mobile app to use than YouTube, But this damn bullshit has got to come to an end, and he'd better fix it because his Doge project has been a huge flaming failure because of president instability. Okay, my rant is over with now. And we were going to bring Ian up next after 6. I apologize for that. If Ian's out there, please come back and listen. I'm going to bring Kalani up into this because, folks, it has turned into an absolute joke trying to do anything on X now. We were talking about the problems with FICO and impacts on retail spending. And when you start translating that over into the mass marketplace and the economy as a whole, it's going to cause an earnings contraction that Wall Street hasn't seen, can't predict, and won't be able to predict. And for that reason, it's going to become a very risky proposition to accept or, and this is the big one here, or believe the E part on price earnings ratios. This is not going to fly. It's not going to fly at all. And it's going to cause major issues for the economy as a whole. And apparently, the president has come out with some more stupid statements. Doc, Kalani can't make it. Doc, on it, no big deal, Kalani. We'll catch you on the backside next time. That's the way this rolls. But let me finish this up. I'm going to get on my trade rant then to close the show out. Let's be honest. If Ian comes back into the room, we'll invite him to speak. He'd request. And if anybody else wishes to speak, just raise your hand, send me a request for invitation. Because let's face it, we have a lot to talk about. First of all, I want to talk about the MacroEdge job cuts tracker. We've done an excellent job tracking this. And I have a theory, and I didn't get a chance to talk to Six about it or anybody else, but let's face it, month to date, it's only been 70,705 layoffs as of yesterday. One of the bigger reasons for this drop-off in layoffs, folks, we had Easter week. It's a holiday week, which coincided with spring break. So you have an entire week of work where nobody was doing anything, and all the big bosses were out of town. So you've taken 1 week out of the month, out of that 30-day period. Everyone was in Florida, St. Bart's, partying their ass off, and getting away from the reality of what we're dealing with. And it makes it a little bit different when you start thinking about that. We don't have oh, I got Bruno here. Let me add him in there. Bruno, go ahead, sir.
Well, thank you. I just wanted to say that we can all zoom out and think about what is advantaged in this situation the market is in. And we talk about the negatives and the risks, which are very important. And in context, nothing that's happening in the stock market this year is at all surprising. It would have been surprising. It's only surprising that it's only happened to this degree. So, with everybody focusing on the ostensible catalysts of tariffs that switches every 15 minutes or whatever and refreshing their 5-minute charts, going crazy, losing money, there are sectors that have done tremendously well that are even advantaged by all of this, like rare earths specifically. And I would just encourage everybody to zoom out, be aware of that, and focus on what's next rather than what is, or wasting time in the sectors that already peaked last summer, like tech, hypervaluations, and AI fantasy um, narratives. To that, I will add that it's arguable we haven't even begun a drawdown. There is record amounts, daily, weekly, going into levered tech ETFs, 3x levered tech, and similar. That is behavior that occurs at mania peaks, not anywhere near a bottom. So we may not even be in a drawdown yet. And if we are, it was written on the wall. Anybody who listens to this show weekly or follows the reliable indicators, everything from yield reversion to yield spreads blowing out, et cetera, et cetera. It's a long list. Some of them have 100% hit rate going back decades, generations. They were all screaming, "It's time and it's happening." but I would suggest maybe it's not even happening yet. Whatever does happen, there are sectors that are doing extremely well that the retail crowd will has not piled into yet. That even includes precious metals, I think. And that's all I wanted to add is just looking at it from the other side of things.
Bruno, I think you're 110% correct. In fact, everyone's freaking out over gold's decline from 3,500 to 3,300, but in the large picture, when you take it out over the last 15, 20 years, it's just like anything else. It's not a big decline. And also, uh, yeah, I have the reputation as a gold bug, but Bitcoin has shown its resiliency. But this looks more and more like an anything but the dollar trade. And I think people should be a little bit alarmed by that. What do you think, sir?
Well, that's a great point. The dollar is on the precipice of a bunch of, well, it's on a 50-year cycle, pretty regular cadence of lower highs and lower lows. And if you draw the trend lines, there's a chart maybe a few days down my timeline, I'm not sure, that shows it. You will see that it's on the precipice of failing a 20-year uptrend channel and a couple other lines of technical support or resistance. If you couple that with the potentiality of 30-year going over 5%, that's the real pull out, bar the door level, I think. So people are talking about expectations for a cut. All the Fed does is follow real rates. That's all it can do. That's all central banks have ever done. They do not lead real rates. So real rates did top at the end of 2023. They've been going lower since. But over the last month or so, if we look honestly at the charts, put our biases and preferences aside, maybe even eat some crow, it's 50-50. Rates could explode higher. And especially if that 30-year gets over 5%, that's where Trump either blinked or executed the next stage of his masterful, artful plan of tariffs, whatever you prefer. That's not coincidental. And none of this will be coincidental. It will be incidental. These are catalysts that are not to be messed with. So keep that on your radar. That goes hand in hand with the dollar. And you're right. It's an unusual situation with markets having sold off as rapidly as they did, whatever the cause was, and seeing the dollar go lower, seeing rates resilient go higher, seeing bonds get sold instead of bought. That's the kind of theft that happens generationally or in a longer cycle, but it's happened, and people looking at the 5-minute charts aren't going to see it because they don't have that view. People that have not been in the game that long and haven't studied history, maybe they've heard it can happen, but they don't believe it. That's the value of a space like this, where there are people with personal history that even share, like people did last week, was it, or 2 weeks ago, the human damage that gets caused, and just don't let it happen to you. Ignorance is no excuse. Nobody in this space has that excuse.
Bruno, thank you so much for your participation. Don't be a stranger to this space, and we're probably going to shop this off in a few other places. Believe me, because we're a little fed up with the instability of the platform. So we're going to look into this because it's a shame when you have hundreds of listeners, then all of a sudden it drops off in tanks. Nobody like yourself gets a chance to ask the questions or participate like you just did, and we appreciate that, folks. I want to follow this up because we're getting towards the end of our hour here within the next 10 minutes. Even with the late start, I'll finish it up. What Bruno brought up is a great point. There is alternative investments and there's also dangerous investments. The reason I brought the Chinese penny stock rallying on the NASDAQ some 60% today is a ridiculous investment. Part of the discussions that Trump has had as quote unquote revenge for Xi's humiliation of his tariff war is to cut off all Chinese stock participation. You cannot buy, sell, trade, or anything inside the United States via ADRs, et cetera. So if that were to occur, you, Mr. Robin Hood, is the ultimate bag holder. There is no, dear ref, can I get a do-over? The money's gone. It's locked up. It's history. You'll never see it again. You can take all the 20s in your wallet and set them on fire. It's no different than investing in Eastern Airlines in the 1970s. So if You want to take a chance on Chinese ADRs? It was a great investment plan last year. They had to do something to stimulate their economy, but that's before the trade war started. And I'm saying this as a friend to our listeners. You've got to consider the dangers of what's happening in this trade conflict. You're hearing the American perspective, the bubble visions, as I call them, Fox Business, CNBC, Bloomberg. You see stories now coming out. Sources said, people inside the administration said, my sources told me, no identifiable truth or documented facts. This is not designed to report news to you. It's designed to pump equities. And it's designed for the big guys to get out of bad positions while you're sitting here stuck thinking, oh, good, things are going to rally. I'm going to go buy some more 0-day option calls or short calls into the next couple of weeks, and I'm going to make a fortune. There are no lottery tickets anymore, folks. Those lottery tickets are gone. If you're going to spend the money on the lottery, go down to your local 7-Eleven, grab a pack of cigarettes or flavored cigars or whatever the hell they're selling now. I don't know anymore. And buy some lottery tickets, get some scratch offs. If you're going to waste your money, do that, because it's too much danger in these high risk, low return investments. A year ago, you could have bought a stock for 57 cents. It jumps to $2, in and out, no big deal. Now, because of the risks with trade policy, economic policy, and what they're telling you is going on, they're telling you they don't know what they're doing. The risk to your personal economic freedoms and well-being is there, cannot be denied. I'm not saying this to sit there and tell anybody this is anything new. Melody and others who were there in 07 and 08. Kenny, all these people that are on the staff here at MacroEdge.net who've been trying to convey information. We saw what happened in 2007 and 2008. I was doing radio at the time, and it blew my mind. As soon as I got a national following, I had EVPs calling me, senior VPs. I had people coming under the radar saying, I can't go on the air. Here's the information. You're going to start seeing that. And we won't use these sources said. We'll try to verify what these individuals tell us, and we'll bring it to you in the appropriate context of a bigger story. I fear that what we're about to see right now is a rug pull of epic proportions. And people need to understand that markets in a speculative bubble like this, and Bruno hit a home run with that comment, they don't just keep going up. It's great, 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 suddenly. And suddenly is the most terrifying part. And I hate to use the analogy of 1929. But in April of 1928, there was a big sell-off. Then in April of 29, there was a huge rally. And then we know what happened in September and October. Is that going to happen again? No, I'm not going to sit there and make a direct apples to apples comparison. But I will tell you from a story, two stories, one from risk.net. When the treasuries had their sell-off, they had a real challenge clearing the U.S. debt. The transactions were of such high volumes, the third-party clearing systems. Throughput doubled to $2 trillion a day following the tariff announcements. And SIFMA said the volume was just trading over 1 trillion before that. So it's hard to process that amount of volume. We start triggering those kind of volumes in our credit markets again. God help us, folks. And investors are warning the administration, I don't think they're listening, that the war with the Fed is also potentially causing lasting damage to treasuries. That's a Financial Times article. Finally, hitting Main Street and hitting the average person. I'm just going to read the headline. Sourcing Journal. It's one of those websites the geeks like me follow. Apparel import bookings down nearly 60% ahead of reciprocal tariffs, April 14th. Folks, we start seeing drops like this. The back-to-school season is going to see shortages, empty shelves. and a real problem that a lot of people don't understand. And they're going to think it's like COVID. And I kept hearing that today. I even heard it with the interview with Craig Fuller. It's like COVID. It's like COVID. This is unlike anything we've ever seen before. And from a historian's perspective, the lasting damage that will be caused by this is something that the United States may not recover from for a decade. Keep that in mind as this moves forward. Unless we get some reality and congressional intervention to tell these clowns to quit pushing the issue to stabilize financial markets and prepare the American people for a run-of-the-mill recession that they could easily turn into something far worse, the risk to our credit and equity markets is off the charts. And unfortunately, with the large number of people in the retired demographic, the quote-unquote evil boomers, if they lose their retirements, you have a welfare problem far larger than the Social Security problem that we keep hearing over and over again. Our country will face the risk of hyperinflating or default. For MacroEdge Radio, go to macroedge.net/ozone, subscribe, get a 2-week free trial, read the writings of this great team, be a participant, learn. We're sharing what we know, and we always welcome other opinions. For MacroEdge Radio, this is John Galt speaking. I'll see you in 2 weeks.